Power Options suite of tools. We will use the Power Options suite of tools, of course, to help us for our illustrations for the different questions that come in from our various attendees at today's presentation. What you're looking at here is a 14-day free trial. For those of you that are currently on your 14-day free trial, I encourage you to take advantage of the 4 steps that are listed to access the Quick Start Guide to get more familiar with the tools and navigation. There's a few flash tutorials that have been set up to help you get familiar with the search tool, some of the other tools that are available. We do host a variety of free webinars during the week. And of course, you can access our archive webinars at any time at the free webinars link. And those of you that are on a trial or subscribers to Power Options, remember that you can schedule a coaching session at any time. It's not a sales call per se, but what it is, it's a just a 45 to 50-minute phone conversation with myself or Ernie. We just walk you through the tools on the site and answer any questions that you have. All right, so one of our, Sam says hi to everyone. Hi, Sam, as a regular here on our Friday discussions. And I've got a question that came in from the Pink Panther. And a moment ago, I had mentioned about the radioactive trading techniques, the married put techniques, of course, that we advocate with a unique setup of the married put position. But Pink Panther wants to know, are you also working on a married call? Well, we do have a married call screen available. We do have married call search tools available as well. Now, am I personally or Ernie personally working on a write-up on how you would reverse the 12 different income methods to switch it from the bullish married put view to the bearish married call view? And the answer to that is no. We're not doing that right now. Okay, I may do that in the near future. But as I mentioned, of course, the married call, instead of buying a stock and buying a put option, we would short the stock and buy a call option to take advantage of the bearish mode. And then you could just reverse the income methods discussed in the blueprint. Now, for blueprint owners, those that have bought the blueprint to learn the radioactive trading techniques, the full setup of what we use, how we structure the married put position, and the 12 different income methods that we use, they also get access to members-only webinars, white papers, and other mentions that you can find at radioactivetrading.com. So as a blueprint owner, if you own the blueprint and you log on to your account at radioactivetrading.com, you can go into the blueprint section here and click on the members-only webinar presentations. One of the webinar presentations that's available for blueprint owners and Fusion subscribers is playing the bear side of the market. And what we do in this presentation is we discuss, Kurt and I discuss the ways that we prefer to approach that limited risk setup if we feel we're in a bearish market. And there's 2 other ways I would do it rather than doing a married call. And there's nothing wrong with doing a married call, but a lot of times with your broker, if you end up shorting the stock, hey, what are you doing? You're borrowing a short sale sort of against your broker. You've bought a call to protect that, that's true. But a lot of brokers over a 30-day time period will charge a margin requirement for the short position. Okay, so what does that mean? It means you're sort of adding to your cost basis as long as you're holding the position slightly based on the margin fees. Some are big, some are extremely negligible. I'll admit that freely, so it doesn't look like more than a commission cost, really, once every 30 days to the position. There are other ways to mimic this stock chart, and there's other ways to trade actually a married put in a bearish market. Meaning that, yes, you can still find bullish stocks in a bearish market, but if you feel the market as a whole is going bearish, you could just do the stock plus put, married put combination on, say, one of those inverse ETFs, or the VXX, for example, with volatility ETN. So, of course, as the market's going down, those inverse ETFs, even the 2 times and 3 times inverse naturally, will move up in price. So you don't have to think backwards. You'll still be in a married put position, still apply the 12 different income methods, but again, stocks are moving up while the rest of the market is going down. In addition to that, of course, as I mentioned, there's nothing wrong with doing a married call, but it comes with some caveats. We look at a different way to approach the married call structure, or to profit in a bearish market, as opposed to just shorting the stock and buying the call and reversing the married put ideas as a whole. Okay? The two things, of course, you always want to watch out for if you're doing the married call where you're shorting the stock and buying a call is you'd never do it against a dividend-paying stock, even if you're pretty bearish on it, because remember, you have to pay the dividend when it comes out. Now, most of the rules have been alleviated, but there are still some restrictions on some stocks for shorting as well. So you may have to look at a different approach to doing that also if that's a stock you're interested in. It's not money, and most of the regulations have been, oops, sorry folks, have been adjusted there and changed. So again, we're not really working on it. You can reverse the ideas very simply. Blueprint owners who have access to the 12 different income methods, they know how to reverse them. I will put something together for Blueprint owners as a pamphlet for reversing it if they choose to do a married call position. But in general, Kurt, Ernie, and myself advocate those other two ways of playing it in a bearish market as opposed to doing the married call position outright for other reasons as well that are talked about in some of those members-only webinars, I should say. Okay. All right. So that's just a brief discussion there on what's available for approaching the position in a bearish market. There's different setups that we might use to take advantage of that risk-reward profile of a married call without shorting the stock and maybe taking on some of the margin costs. In addition to that, there are ways to reverse all 12 income methods and apply them to the married call. And I might have a write-up on that available in the next month or two, depending on market situation and what we see happen. Okay. So thank you for your question, Pink. Interesting question. It's a renewed question that I actually had a discussion with. I mentioned it in the email for the webinar. One of our customers was asking a question about, is it better to do a bull call debit or a bull put credit spread? And I mentioned in the webinar that was one of the email discussions I had during the shortened trading week. But John, it looks like, asked a question here again. John just prompted in with a question about talking about, well, is it better to do a bull call debit or a bull put credit? Okay. Now, before we begin, let's introduce what those two strategies are very quickly. The bull put credit and the bull call debit are naturally bullish vertical spreads. They make the max profit when the stock is above both strike prices, whether you're doing a bull call debit or whether we're looking at a bull put credit. Okay, the max loss is occurred if the stock drops below the lower strike price. They're parity trades of one another. They have the exact same risk-reward profile. Okay, now the question that I had answered during the week was, if my goal is to avoid early assignment for these positions in a bull put or bull call debit, which one is the best to do? Okay, well, in general, when I'm opening one of the bullish vertical spreads, the strikes I'm selecting are usually below the stock price for a better probability of success on the trade. We'll look at that in just a moment. But think about it this way. We have a stock trading at about $50 per share. How I personally might structure a bull put credit spread, whether it's 1 week out in time, whether it's 1 month out in time, is I'm going to sell an out of the money put. Okay, so let's say I'm going to sell the 48 strike put that's 2 points out of the money, and maybe I'll get 75 cents. At the same time, I'm going to buy a further out of the money 46 strike put perhaps, and this might cost me 20 cents. Anyway, maybe this is only, let's do it this. This is 55 cents and this is 20 cents. So I'm going to receive a net credit up front of 35 cents as long as the stock stays above 50. At expiration, both puts expire worthless, we keep that net credit. Now I do have a risk. If the stock drops below 46, I'm going to be forced to buy shares of stock at 48 because the obligation of the sold put, but I have the right to exercise my 46 put, which forces someone to buy it for me. So even if the stock dropped down to 40, I can't lose more than this $2 between the strike prices. And regardless, I keep the 35 cent net credit. So really, my max risk is 165, the 2-point difference in strike prices minus the 35-cent net credit. Okay, so it's a pretty decent leveraged return. The likelihood of the stock staying above 48 comes down to the probability at the time I enter the trade, and let's say it'd be 74% probability the stock would stay above 48. Okay, and that's a bull put. I have to put up this $1.65 or the full $2 times the number of contracts times 100 at my broker. I have to have that on hold in my account to place the trade, because the outcome is I may have to pay that back. I may have to cover this spread. Broker wants to make sure that I can cover it if the stock falls completely against me. Now, if I did this with calls, I would do the same thing to have a better probability. But now, with our stock at 50, I'd be selling the in-the-money 48 call and buying a deeper in-the-money 46. Okay, so this might cost me $5, and on the, remember the stock's at 50, I'm sorry, this might cost me $5, and then I'm going to receive maybe $2.65 or so for the 48. Okay, so again, well, that's not going to work. I'm sorry. It'd probably be closer to, let's say, 360, 335 or 4. Let's call it 435. I'm sorry, it'd be 435 in that case. My apologies. So I'm paying a high debit into the position, but now I don't have to cover any margin. Okay, so let's say I pay a debit of $1.65. If the stock stays above 48, well, I buy stock at 46, sell it at 48, get $2 back, and then I receive the 35-cent premium. Okay? Well, let's take a look at a real example so it's a little bit more clear. I'm going to go to the custom spread tool. Let's just take a popular stock. We'll just use Apple. This is not a recommendation or suggestion, but we're going to take a look at the monetary comparisons of two different spreads. Let's go to standard July expiration, 14 days away, July 21st. With Apple at 144.18, why don't we go ahead and, let's see, that's not high enough. I'm going to sell the 142. I know it's only 2 points out of the money, but we're going to go ahead and do that. And we're going to buy the 140. So this would be a bull put. We're going to go 102 to 59. Okay, we're going to sell the higher strike at 102 between the bid and ask. I'm going to buy this at 59 cents. Okay, around midpoint. There we go. Now, this is a net credit between the two of 43 cents. I have a $2 difference in strike prices that I have to cover, but most brokers realize that you really only have to cover the difference in the strike prices minus the net credit, so I'm going to have to put up $1.57. But your broker may require you to put up the full $2, but in the worst case scenario, the most you can lose is $1.57. If the stock stays above 142, both puts expire worthless. We would keep the net credit without having to do another transaction. That's important. The options just disappear. So the 43 cents against the $1.57 risk is a 27.4% return. Okay. Max return again is made if the stock stays above the short put. Max loss is made if the stock drops below the lower strike option. And the question was asked about avoiding early assignment with these spreads, which can happen. How can it happen? Well, anytime you sell a call or you sell a put option, regardless if it's in a spread, a debit spread, a credit spread, a calendar spread, it doesn't matter. If the stock, for in this case, drops below our short put, this is the bull put, so it drops below the short put, remember what our obligation was. When I sell a put, I've entered into an obligation to potentially buy shares of stock at the put strike price. So the only way I can get assigned early on a bull put credit spread is if the stock falls below 142 anytime between now and expiration. Okay, when that happens, I might get early assigned, and I might end up buying 100, 500, or 1,000 shares of Apple at 142, depending on how many contracts I sold for the spread. If I did 5 contracts it fell down to 141, and someone decided they were concerned, so they closed out this put or exercised it, the 142 put, they bought it, I sold it. Well, I may end up buying 500 shares of Apple at 141. Now, am I covered with the 140 put? No. Remember what I did when I bought that put. That put gives me the right to force someone to buy my shares of stock at 140. But if the stock's on the market right now at 141, why would I force someone to buy my shares of stock at 140 when I can sell it at the market at a higher price? Okay, so this is still out of the money if the stock's between the strike prices and a bull put. The long put only helps you when the stock falls below both strike prices in that case. I could sell to close the put, get 10, 15 cents back, whatever. Okay, but early assignment only happens if the stock falls, and it probably won't happen depending on the situation of the fall. If it's bad news, unexpected news, you might get assigned early with the bull put now. Okay, now it gets tricky when you're talking about the debit spread, or even this also applies to calendar spreads, and I'll talk about that in a moment. But let's reverse tracks now. Let's jot this down. This bull put credit would have a 43-cent net credit, one contract only, okay, for a risk of 157. So we're looking at a 4-to-1 risk-reward ratio, a potential return of 27.4%, and let's say our probability is around 70% that the stock would remain above 142 at July expiration. Another way to skin a cat. We talked earlier about the married call approach to the radioactive trading married put position. I talked about how I prefer to use a different structure, one of two different structures opposed to the married call, that creates sort of a parity trade. Well, at least one of them does. Well, almost every options trade has a parity trade, at least one. The parity trade to the bull put credit, one of the two actually, would be the bull call debit. So rather than selling an out-of-the-money bull put credit spread, where I'd only get assigned if the stock fell below 142, or only risk assignment if the stock falls below 142, I could choose to enter a bull call debit spread. I would do the same strikes, the same structure, but I'm using in-the-money calls and paying a debit instead of out-of-the-money puts and getting a credit. Okay, so let's sell the 142 call, midpoint of 330. By the way, this is not a recommendation or suggestion of opening a bullish spread on Apple come Monday. Okay, I'm just going through an example here. All right, so we're going to sell the 142 at 330. We're going to use midpoint on the 140, which would be 490. So right away, this actually looks a little bit better. What do I mean by that? Let's take a look. Let's put in our midpoints. We're going to do one contract only to keep the math simple. So I'm going to sell our 2-point in the money July 142 call for 330. And I'm going to sell the roughly buy the roughly 4-point in the money 140 call for 490. Okay. Oh, I'm sorry, this actually looks slightly worse. My apologies. What do I mean by slightly worse? I got reversed in my head. I know it can happen when you talk about these two strategies. It happens to the best of us. Well, here my debit is 160, which means that if the stock stays above 142 at expiration, I'm going to have the right to buy shares of stock at 140 to cover my obligation to deliver stock at 142 with the calls now. Okay, so the obligations don't change. I still have an obligation to deliver shares of stock at 142, but I've purchased the right to buy them at 140. So if the stock stays above 142, the higher strike option naturally, at expiration, I close it out, get 2 points back. I had a debit of 160, so my profit is 40 cents or a 25% return. Okay, now it's close, but the bull put credit was better, wasn't it? At midpoint, we were seeing 43 cents of net credit for a 27.3%, 27.4% return. Okay, so the bull put has a better return slightly, but it's still a better return. In this case, it's not always the case. Sometimes the bull call debit will have a higher return at midpoint prices. But in this case, the bull put credit is higher return. The probability is exactly the same. What's the probability of the stock staying above 142 and the bull call debit? the exact same probability it was that the stock would stay above 142 in the bull put credit. Now, the customer was asking, what should he do to avoid early assignment? Why would you want to avoid early assignment? Because sometimes the broker gets tricky with you at early assignment. I've seen it happen twice in the past few months. One on a bull call debit spread that we're looking at, one on a calendar spread, which is very similar. It's just that this 140 call that was purchased was much further out in time. It was 4 or 5 months out in time, so it was a diagonal spread instead of vertical, which means same expiration cycle. Now, when we start with the calls, this bull call debit, we are in the money. Our 142 call is in the money. Our 140 call is in the money as well. What does that mean? Well, it means we have a good probability of the stock staying above the strike price we sold to receive the maximum profit at expiration in 14 days. What it also means is that we can be assigned at any time. And there's no guarantee. We know several brokers do this, especially the discount online brokers, but there's no guarantee that if you were assigned early at 142 because your call is in the money at the start, there's no guarantee your broker would automatically exercise your 140 call to force the sale of the stock at 140 so you'd get the $2 back. What does that mean? That means if you get assigned early a week before expiration, you would now be short, going back to Pink Panther's comment, you would now be short shares of stock at 142 and you'd own a 140 call. So you're short stock at 142 and you own a 140 call. So now essentially what are you looking at? Well, you've got a married call. Okay, you've got a short position in that situation. Okay, that's not kind of the risk-reward profile that you wanted, is it? Not exactly. Okay, why wouldn't the broker exercise automatically? They do at expiration. Okay, if the stock was above 142 at expiration, remember you have an obligation to deliver shares of stock at 142 for the short option. You have the right to buy shares of stock at 140. So if I held it through expiration and did nothing, over the weekend my broker would buy shares of stock from me at 140, sell them at 142, I get the $2 back, I make the 40-cent profit on a 160 investment, the debit, and there I go. Okay, 25% return. But remember, the obligation of a short call is that you've agreed to deliver shares of stock at this price that you don't own. You entered a spread. I know this. You know this. Many of the discount online options brokers know this. Old school brokers haven't exactly caught up. It's happened to 2 of my customers, as I mentioned, in the past 3 months, where they got assigned early on the short call in a bull call debit spread or a calendar spread, and the broker shorted the stock for them and didn't use the long to exercise the short. Okay? Now, in one case it worked out. The stock sort of fell. They were able to buy back the stock at a cheaper price to close the short, and they just sold to close the call. It came out okay. It wasn't the full profit, but it wasn't near the maximum loss. Another one, it didn't work out the way they wanted to because the stock recovered, which looked okay. You know, because they were short stock and they have to cover it, but that's why you've got that long call there as well for that position, okay? Yeah, and this is, Guy had mentioned, and Guy is the gentleman I was having the email with over the week, but Guy says the thing is they don't look at the spread as a combo, but as individual trades. Some will look at it as a spread, and one of the gentlemen that I had a discussion with a few months ago, 2 or 3 months ago, when he was in the diagonal spread, the calendar spread, what was really awkward about it is that they shorted, was it 700 shares of stock for him in the diagonal spread because they assigned the short call 2 weeks early. Okay? No, I'm sorry. It was 1 day early. It was Friday. It was going into Friday expiration of the short option, and his long option was 2 months further out in time. And it was slightly in the money, but he was just going to close it out Friday afternoon. He got assigned Thursday when it was slightly in the money, because one thing he accidentally didn't pay attention to, Friday was the ex-dividend date. So what happened to him? He got assigned and was short 700 shares of stock on Friday. And remember, he had entered a diagonal spread that looks like this. But now he's short 700 shares of stock on Thursday, sees Friday morning that he's short 700 shares of stock and they didn't exercise the long that's 2 months out to cover the short. Guess what? He crossed ex-dividend. He had to pay the dividend on 700 shares. So he took a much bigger loss on the position because once you're short the stock, you've got to pay the dividend. And that's what ended up happening to him. He was still in a low-risk married call trade at that point, but he lost more than he thought he could because he had to pay the 10-cent dividend on 700 shares. And of course, the stock continued to rebound after that. So he was holding the long call. He had to try to close out of it on Friday, but it already triggered the ex-dividend because he was on record of being short shares of stock as of Friday morning. Really ridiculous, but that's why you get assigned early in these situations. You'll get assigned early if there's an ex-dividend coming up and you're holding an in-the-money short call. Whether it's part of a covered call, a diagonal spread at the near expiration, or a bull call debit. Now, one thing that is interesting about this, remember I said that you can't get assigned on the bull put spread until the stock falls below that short put strike. That is true. No one would exercise their put if the stock was trading above the put strike price, okay? They wouldn't force someone to buy their shares of stock at a lower price. They're going to sell it at market if they want to. But now, what it comes down to is that in the case of being assigned early on the bull call debit, remember this is July 21, 14 days out. So let's say next week, Thursday the 13th. Okay, let's say at that point you get assigned on the short call and the stock's at 145. For whatever reason, you got assigned on Thursday the 13th and now you're short shares of stock at 142. Well, guess what? Your 140 call is still in the money. You can exercise that now, cover your short at 142 by essentially buying shares of stock at 140. You get the $2 back. You've made the max return 7 days early. So sometimes early assignment is not a bad situation because you may be able to get the max profit on your position sooner. There's no guarantee you're going to be assigned early. In fact, in most cases, in-the-money bull call debit spreads will not get closed until the last hour or be held through expiration if they're in the money just to close out the position. But one last thing before we move on to our other questions here. What are the advantages and disadvantages? Okay, here we've got a bull call over here. I mean, it's pretty simple. We've gone over it, but let's just jot them down. And over here, I'm going to write out bull put. Well, the first thing is obvious. This is a debit. Bull call will be done at a debit and the bull put will be done at a credit if structured properly. If you structure a bull put incorrectly, guess what? You're in a bear put debit spread. If you reverse the strikes, you sell the 140 and buy the 142, you're in a bear put debit spread, okay? So that's the obvious one. One's done at a debit, one's done at a credit. They are parity trades, so they'll have a similar risk-reward profile. Number two, this starts off in the money, so there is the risk of early assignment where you might end up being short shares of stock because of the in-the-money call. Not necessarily a bad thing because you might be able to get the max profit sooner. The bull put should start off out of the money. Now, why do I say that? It's because we want that probability of 70-75% of success, which means you're in the money on the bull call below the stock price, or you're out of the money using puts, which still means you're below the stock price, but you're out of the money. Okay. Commission-wise, is there a difference? Yes, there is. Remember, to get the maximum profit, the stock stays above 142, these options expire worthless, and you don't have any other commission fee in the bull put. There's no other extra commission fee if the options expire worthless. You may have a small fee for expiring options. They might charge you 4 cents or 3 cents. Some people do that. Some brokers do that, I think now. I think a lot of them do, actually, excuse me. But you don't have to pay anything else. Your options just expire. In order to get the max profit in the bull call debit spread, what do you have to do? Well, you either have to sell to close the 140 and buy to close the 142, or if you leave it through expiration, your broker essentially buys shares of stock at 140 and then sells them at 142. So you're going to have at least one, but likely an extra set of commissions to close the bull call debit spread. Okay? And that may be important if you're trying to do high probability weekly spreads. So if you're just looking 5 days out, on Monday you open spreads for that Friday expiration that's 5 days out, and you want a 75, 80, or 85% probability, you're talking about a max profit of maybe 3, 4, or 5 cents on a $1 spread, maybe 8 to 10 to 15 cents on a 2-point spread, maybe 15 cents on a 5-point spread, and so forth. Okay? So unless you're doing 10, 20, or 30 contracts, if you're only doing 5 contracts or so, and your maximum return, let's say, is 8 cents against $1.92, but you have a 90% probability, you did 5 contracts, that's $40, right? That's a $40 credit for a risk of close to 1,000. I know it's not a great return, but I'm talking 90%, 85% probabilities here. Well, you might have paid a commission of $11 to get into the trade, and then to close it, to get the full profit, you're going to have to pay another $11, $12, $10 to close out the spread. Okay, so that's 50% of that profit on a high probability 5-day trade. So keep that in mind, that you have to pay the extra commissions to close them out. So it is in the money. You may risk early assignment. That may cause a headache, but it also may get you to full profit faster if you're signed early. The bull puts out of the money does not have an additional commission. And of course, in both cases, you know, if the stock falls, you lose the entire debit you paid and have 100% loss. If the stock falls, you have to cover the margin that you had on hold here. So it's not a free trade. You know, that 43-cent net credit we're getting is not free. I'd have to put up 157 and have that on hold in my account the entire time the trade is open. If the stock falls below that, I'll have the maximum loss. Okay, so you lose the debit here that you already paid out in the bull call, but you'd have to cover the margin. Okay, remember, you pay out, I know, stupid to say, but you pay the debit out, so you see that disappear from your account when you do a bull call. When you do a bull put, you'll see the credit come in right away. It'll be deposited in your account right away, but you still have to cover the margin for the difference in the strike prices. So what's the answer? Well, if you're worried about early assignment on spreads, you'd stick with the out-of-the-money credit spreads. Okay, the debit spreads are usually done in the money if you're looking for a probability above 50%, anywhere above 50%. Doesn't matter if you're 60, 65, 75, or 90% is your trade regimen for vertical spreads. That's a probability you look for in those ranges. But if you want at least 50% or more, you're at the money to in the money on a bull call debit and at the money to out of the money on the bull put. And then, of course, same goes true for the reverses, the bear put debit and the bear call credit. How would I avoid early assignment? By using the out of the money bear call credit if I'm bearish on the position. Because again, just like the bull put credit, the stock in a bear call, I'd be selling, let's say, the 146 and buying a 148. So this would be our bear call spread here, of course. The only time I'd get a sign on the bear call is if the stock moved above my 146 strike, because now my short call's in the money, just as we started off with the bull call debit. I don't want to confuse too much with the vertical spread commentary there. But yes, it's something to be concerned about. And if you're not concerned, but it's something to be aware about. And if you're doing these vertical spreads, why are you doing them? Well, you want leverage. You want to see 15 to 20% returns off a lower amount of your portfolio, either invested as the net debit or as the margin requirement for the credit spread, so you can enter more trades. Keep in mind the lie of leverage. The more trades you enter, remember, you can lose 100% of what you're investing in a bull put or a bull call debit if the stock moves against you. Okay, so just keep that in mind. It's great to see a 20% return by only putting up 2 points to cover the margin, or a 2-point debit, but you could lose that full 2 points if the stock falls 3, 4, or 5% in the next 3 to 5 days. It's a possibility. It's got to recover by expiration. If it doesn't, you're out 100% of what you invested. So that's the trap of the lie of leverage. If I did 20 contracts because I could afford to on a 2-point spread, I'm risking that full $4,000, 20 contracts times the 2-point spread times 100. Okay, all right. So that's just sort of the review of talking about what is the difference between an in-the-money debit spread and an out-of-the-money credit spread. We focused, of course, on the bullish spreads, but the same ideas, just slightly reverse thought, apply to the bearish spreads also. And remember, if you wanted more information at any time on these spreads or management techniques, for example, you can go to our archive webinars page at any time. Of course, it is a free page. You don't need an account, even a trial account. It's a public page, I should say, not a free page, but it is. It's a public page, so you can just go to powerup.com/webinars.asp. We've got webinars on the tools and the various option strategies. In the option strategies section, you'll see information here for managing bear call spreads and bear put spreads, managing bull spreads, and of course, what is a vertical spread? That's where we review the 4 vertical spreads, of course, and the parity that exists between the bull put credit and the bull call debit, and the bear call credit and the bear put debit as well. Okay, there's 2 ways that I'm going to answer this question, and we're going to show an example of it. I think of the best way to do it, but anyway, a follow-up question, this discussion on spreads. We discussed weekly spreads. Guy asks, is there any specificity regarding weekly spreads, or are they the same but the percent is a lot less? The net credit is a lot less, Guy, so the percent is a lot less. And both Ernie and I have run tests, and you're going to see details on one of those tests coming up next week in the form of a blog, of course. You also receive an email about it, which goes back to what we discussed a couple weeks ago, comparing weekly covered calls to weekly bull put spreads. First, I'm going to go to our spread chain tool. I'm going to stick with Apple real quick, okay? And yeah, I'm going to go to the spread chain. And let's just go to, let's stay with credit spreads. So I'm going to take a 2-point spread width. What this tool allows me to do is see midpoint pricing for bear call spreads on the left, bull put credit spread data on the right. And I'm just going to put in some minimum criteria. I like to stick with a 2-point spread. I'll explain why in a moment. My minimum net credit on the position, I am going to keep it at 5 cents. And we're going to want a 70% probability. Return, I'm going to lower to 5. You'll see why in a moment. And the out of the money range, I'll leave at 0.5. Okay, so let me leave that data. What I'm telling the system to do is find me the bear calls and bull put spreads on Apple where the spread width is 2 points. There's at least 5 cents of net credit. We've got at least a 70% probability, and the return is at least 5%. And I'm going to go 7 days out to July 14th. Notice that there's just one each that matches this. And for the bull puts, it's close to what we were doing. I'm sorry. There we go. My apologies. There we go. There's the one that we were doing, right? We should have thought that that would come up, right? But there's, for 7 days out, the 142, 140 bull put spread would get a credit of 26 cents. We looked at 14 days out where the credit was 43 cents on the same strikes, same 2-point spread. Probability here is 70%, and it's a 14.9% return for 7 days. Annualized return of 779. Okay, but let's take a look. Let's go to July 14th. There's more spreads that match it. Oh, and that's interesting. See now, because it's further out in time, wow. See what I'm doing here? See the 142, 140 bull put doesn't come up because the probability is less than 70%. Okay? So, but remember what we would have seen. I'm going to go down to 65 and hope it's there. It should be. Still not there. How about that? One last run. Even though I'm increasing it on both, I'm sorry, one last run, and then we'll highlight the ones we want. There we go. Okay, so why did I keep doing that? What we looked at on the chart was this 142-140 spread with a net credit, remember, of 44 cents or 28.2%. Okay, looks like a really good return. It went up a little bit from our net credit. We were at 43 cents. So you get 44 cents off of a 2-point spread, 28.2% return for 14 days. There is only a 64.5% probability, so it wouldn't have matched my criteria. But the 7-day out position, bull put, same strikes, 142 to 140, 7 days out is at 26 cents, 14.9% with a 70% probability. Okay, so right away, the idea is what you're going to say. What is the specifics of, specificity of this? Is it better to go 7 days, 7 days, 7 days, 7 days? Right away, everyone's going to say, yeah, probability is better. I agree with you. The return is lower, but the annualized return is higher. If I'm able to get 14.9% every 7 days, that's a huge annualized return. And you're right. So return annualized is much better. So who cares if I'm only getting 26 cents? Because if I did this 2 weeks in a row, that would be 52 cents of net credit total. So if I did a spread on Apple and got 26 cents for July 14th expiration, then assume that I could get close to the same on this one, I'd have 52 cents instead of 44. So it's better to do the 1 day out. I'm sorry, the 1 week out. Okay, I could go to 1-point spreads and you'd see a similar ratio. I could go to 5-point spreads. You'd see a similar ratio. Naturally, the spreads that are closer and have shorter expirations are going to have a higher annualized return. It works with any option strategy. You're looking at covered calls. Before weeklies were available, why did every broker, every guru, and myself included, would tell you that when you're selling covered calls, you only want to go 30 to 45 days out in time? Say, oh, but the 6-month option is so much higher in price. Yes, but it's not 6 times the cost. You get a better annualized return selling going month by month by month, or now week by week by week. And at the same time, you get a lower annualized cost when you're buying, whether you're buying options for insurance, speculation. If you buy further out in time, you have lower cost per day. But think about, what we also have to think about is the worst case scenario. Let's take a step back, okay? And let's do what we'd actually look for. I did this to show the 142, 140 combination here. But I'm going to do something else. 141, 139. No. Let me go back to our 70% range for our probability on these 2-week comparisons on the bull puts, okay? Or on the credit spreads. I'm ignoring the call side for right now. Let's just focus here. Okay, so now that 142, 140 is gone for our 2nd week out. Why? Has the return we want, has the credit we want, does not have the probability we want. Let's say I wanted to go to a higher probability. So I go to the 78% probability. Let's say I'm ignoring strikes. I just want a probability above 75. In fact, why don't I just do that? Okay, I'm going to keep that minimum return I want. I'm going to keep that minimum net credit I want. But I'm going to jump up to a probability that the stock will be above both strike prices of 75, whether it's 7 or 14 days out. We get 1. Now, there's multiple spreads that have a probability of greater than 75 for next week, but they're not offering a 5-cent net credit, and they're not offering a 5% return. Our closest is the 141-139 spread, okay, which at a 78% probability is a 16-cent net credit or an 8.7% return. Would you be better off doing the 142, 140? It seems like we're splitting hairs here. Well, you get a higher 22-cent net credit and a 14.9% return if you've got a 70% probability. You're only 2 points out of the money here. You're 3 points out of the money. It's a decent comparison on a weekly spread, isn't it? What else do we have to keep in mind? If I go to the 2 weeks out and I go close to this range, I'm going to take the 76.4. Not quite 78, but more than 75. And I get 22 cents of net credit, which is a 12.4% return on my investment. So 12.4% return 76.4% probability versus 8.7% return and a 78% probability. Okay? This is minuscule, but I want you to keep in mind the difference. Where am I going with this? Ernie's testing, my testing that I just finished when I just was doing the covered call weekly versus the bull put weekly as a comparison, and I ran our historical test against it. You'll find out those results next week. Is that both Ernie and I found out that when you, through historical testing, when you're doing vertical spreads, and it's interesting, it didn't work this way with covered calls, honestly, or cash secured naked puts, but with the vertical spreads, we always have a higher return over time. And my testing time is a 2-year period, okay? But over time, I had a higher return when I was using options that were 14 days out in time as opposed to 7. Why? Because whether you go 7 days out in time or 14 days out in time, regardless of what probability you look for, you're going to have strings of losers where you're going to take the full loss from an unexpected event. It's going to happen. What are we looking at here? I'm looking at making 22 cents on a 2-point spread 2 weeks out. So what are we talking about there? We're talking about an almost 8-to-1 risk-reward ratio. Here I'm making 16 cents on a 2-point spread. Okay? We're at about an 8.5 to 1 risk-reward ratio. It means one loss at 2 points is probably going to wipe out 8.5 previous trades. And I know this one is very small in comparison-wise, but you know, if I went up to the 141, 139 here with a probability of about 70%, we were probably closer to a net credit of 35 cents, which is near double that. I'm sorry, it'd probably be 31 cents. But if I took a full loss and I took in 31 cents, I've lost $1.69. I take a full loss here, I lose $1.84. That adds up really quick. Because of the lower net credits, and because that no matter what you do, you have strings of winners and losers in your positions, both Ernie and I have found through historical testing that using the same criteria, same exact criteria for a bull put credit spread that I'd search for, the losses are compounded faster because of the smaller net credit, but if you go 2 weeks out, it's lessened a little bit, and it was outperforming using the same stock, same selection criteria, same minimum net credit and more. It was outperforming the 7-day out series. It really, really was. And that was the idea there, okay? No, okay, James, you're right. James says the midpoint spread chain does not consider open interest or bid ask. No, it doesn't. It's really just trying to get you to a point, and besides on Apple here, I wouldn't even be worried. All of these are probably in the hundreds of volume and thousands of open interest because they're still within a reasonable range of the stock, whether it's 7 days out or 14 days out in time as well. This tool was designed to just very quickly be able to find spread positions at midpoint based on 5 simple criteria. So rather looking at, honestly, our tool that's slightly flawed, when you go to the search by symbol tool for vertical spreads, bull puts, bear calls, or more, when you simply just go to the search by symbol tool, it's not using midpoint. You can see all the data, but you can't restrict it. What you just see is a simple list. But James, there's a very quick way, and it's not based entirely on midpoint yet, but if you wanted to incorporate open interest into the search, of course, rather than doing an open search and seeing everything, let me take this, I'm sorry, I'm going to jot some numbers down here. I'm going to go back over here. So I want a 2-point spread width, I want a minimum 5-cent net credit, 5% return, 75% probability. All right, so I'm going to go to the bull put search now. I'm going to clear out my settings. I'm going to look at any expiration from 0, let's go 2 to 15 days out in time. Net credit was 5 cents. Turn was 5. Oh, sorry, folks. Probability was 75. What am I missing, folks? Nope, that's it. Oh, okay. Now let's say, though, you wanted to make sure that you saw at least 10 contracts traded today, and you want an open interest of at least 1,000. Okay, but remember, I only wanted to look at Apple. So now I go to the fundamentals there, type in AAPL. There we go. Okay, so all of those spreads that we saw, the 140 to 138, oh, my apologies. Strike difference, that's the one I forgot, folks, equal to 2. All right, so there we go. So that would have limited your universe down to just 4 positions, James, 4 spreads. You can use the search tool. There's a function here under fundamentals where you can just look one stock at a time. So now I've limited this to just the one that was 7 days out and the 3 that were 14 days out that had that minimum open interest and volume as well for my positions also. Okay, but yeah, you're right. In the spread chain, it's not looking at data for open interest. Sorry, open interest or volume as a search, because it's just a quick filter to narrow down one stock at a time to what we felt were the 5 most important things. Spread width for your risk factor, minimum net credit, of course, range out of the money, but really probability is more important as well. And of course, you can jump into further research and analysis here, and you know, we could go into the different options themselves and look at more data there as also. But yeah, it's something we might be able to add into it, but right now, of course, it doesn't. Okay. Oh, Guy, I think I just answered this question based on my example. But I'm not sure. It says, when is it better to initiate the weekly option strategies, whether 1 week out or 2 week out? I sort of answered that, is that our preference is that, and you'll see that when you go into our default bull put credit spread search, for weekly bull puts, we're going 8 to 17 days out in time. Why? Because historical testing showed us that the options that were 2 weeks out had a better return long term, because the losses weren't as affected, because you received a decent net credit. Okay, Lulu's inflated right now, but let's take a look. Here's the 56.5, 55 spread. Jeez. 0.50 cent spreads, $1.50 point spreads. It's ridiculous. I'll be honest with you, folks. I find it ridiculous. Let me make an adjustment here. Let's change this one. But anyway, why our default searches when you go to weekly bull put guy and weekly bear call are 8 to 17 days out as our default is because when Ernie took that same exact criteria that was in the default and tested it for 7 days out or 5 days out, he had a lower return over a 1 year or 2 year period with the exact same criteria other than changing the expiration date. The same stocks, okay? The same stocks going 7 days out and getting that net credit over time. The losses were impacting more of the winners, and it was wiping out more trades. It wasn't as successful as the 2 week out series, okay? So again, another example, BHP. Yeah, BHP, 20, oh gosh, it's the exact same return, isn't it? A 22 cent net credit, 12.4% return with a 36-34 spread. Now let's go to search by symbol real quick. And that was the 36-34 spread. Okay, let's go here, all weeklies. Really? I'm just going to do this manually. There we go. Oh, I know why. I'm sorry, folks. Let's do Celgene. My sincerest apologies. The original Celgene spread is the 128, 126 with 22 cents. Okay, 128, 126. Now let's see here. This should have what I want. Yep. 128, 126 for 7 days out is a 6 cent net credit. Whereas the 2 week out, 128, 126 is a 22 cent net credit. So what does that mean? That means if I took the maximum loss in this 2 point spread, with the 2 week out, I'd lose $1.78. And let's say this is my average return. So still, I mean, that's at my average net credit. Still, that's not good. Don't get me wrong. Okay, so what we're still talking about there is that we're wiping out essentially 12 trades. Okay, if I took the full loss of 178 on that 2 point spread, I wiped out 12 previous trades. But if I went 7 days out on Celgene and I got a 6 cent net credit for a 2 point spread, okay, That means I'm risking 194. And if my average for a 5-day trade is 6 cents, but I take a loss, a full loss of 194 for one of those weekly trades, what did you wipe out? Again, you're talking about taking out almost 30 trades, 30 winners, as opposed to 12. And you will have strings of winners and losers. You will have positions, of course, where that gets wiped out further, okay? So we feel 2 weeks out is better. Now, if you're asking the question, when should you enter it, my personal testing, when I run my historical test for the weekly options, I open them the Monday following an expiration, which if you're using weeklies is every Monday, but I open on Monday. I don't hold a position through the weekend because too much can happen. Now with the weeklies, it's tricky because the combination of what you could get Friday to what you could get Monday on the same spread might be vastly different percentage-wise. Your credit might drop from 10 cents to 10 cents to 8 cents over the weekend because you lost 2 days of time value. Doesn't sound like much, but think about it. That's 20%. You lost 2 cents of what was a 10-cent possible net credit on Friday. You lost 20% of what you could make. It's kind of interesting, huh? But I don't want to take the chance of holding it over the weekend and something happening. Geopolitically or anything along those lines, the black swan, the unexpected that happens over the weekend, I'll look to open on Monday and have it during the week. Now, I know anything can still happen in the pre or after market hours. That's why you take that chance as well, okay? Okay, James asked a question that I meant to get to. James, thank you for reminding me. I didn't. In my testing, I also showed that this, actually, I haven't done that test yet. This is a personal preference. I'll do this test before I post those results. I'll do the test with 1 point versus 2 point, James. But James did ask, why do you prefer a spread of 2? Okay, this is in one of my other webinars when we talk about the management techniques, okay, for a spread. Here we are in a bull put on Celgene. I would have sold the 128 and bought the 126. Okay? Fair enough. 22-cent net credit, 12.4% return, 70-ish% probability. All right? Why do a 2-point spread instead of a 1-point spread? Okay, or instead of a 50-point spread, which is now available all over with 50-cent strike difference. You could do 50-cent spreads, 1-point spread, $1.50 spreads only, 2-point spreads, 250, 3, gets confusing. All right, so right away, James, you can see one of my answers, which is nothing statistically, but the reason why I do it first is simplicity. A 1-point spread would give me an 8 or 9 cent net credit. All right, so if I do 5 contracts, I make $50 off of $500 risk. Still 11% return, 12% return, but I'd rather see the moneyness, okay? 5 of those, $100 in my account. $110 in my account. Risk of 5 times 178. I know, higher risk. But the other reason why I like to do 2-point spreads is because other testing I did on management techniques, one of my approaches is if I was in this spread and Celgene, let's say, dropped to around 128, I'd say 60 or 65, I'm going to start considering managing this position. Okay, I'm going to consider adjustments. One of my adjustments I like to use is to, depending on how much time has passed, this is only a 14-day spread. Let's say 8 days later, 8 trading days later this goes, so I only have 5 or 6 days left. I may be able to buy to close my 128 put, which is now close to at the money, and sell the 127. Okay, so if I think it's come to this point and maybe it's bottom, but it may go a little bit lower, I give myself more cushion by moving down 1 full strike. Now I've got a spread at 126, 127, which isn't going to give me a 12.4% return. I know that. I'm going to pay a small debit to go down 1 strike. But if it still offers me a positive return, 3 days from now at expiration, I've given myself another point cushion, and I didn't have to move the whole spread. Roll the whole spread further out in time or to the next expiration. I just move down 1 strike to see if this works, can still have a positive position, not the full amount I want, give myself another little cushion. That's why I like using 2-point spreads. Okay, so I have that option to roll down 1 strike without having to roll both legs of the spread. See, if I'm in a 1-point spread, if I'm in the 128, 127, and the stock starts falling, I don't have that option. I can't buy to close my 128 and sell to open a 127 because I can't be short and long the same option in the same account. I don't want to sell the 126 because now I'm in a bear put debit. Now, if the stock fell below 126, that'd be profitable. That's another discussion that we go through in that webinar on managing your spread positions, honestly. Okay? Okay, now there's an argument. And it's not an argument, it's a point of fact, and you're right. So the point of fact that was brought up by Tim is that, well, you could do the same thing with a 1-point spread if it offers 50-cent strikes. You are 100% correct. I don't have to roll to the 127. I could roll to the 127.50 if it's available. So why not do the 128 and the 127 that only has a 1-point risk or 90-cent risk here, as opposed to doing this that has a $178 risk? Well, it's because when I started doing the various testing a few years ago, the 50-cent strikes weren't there yet. They were only dollar strikes. But again, what I have seen, and I'm gonna prove it again with the testing when I read it for the bull put weeklies, in addition to why I felt the 14-day ones worked better, what Ernie found a year and a half ago, what I found with my recent testing, that the 14 had a higher return over the 7, even though it meant less trades, which saves commissions, which we're not even including in the back testing, but it would save commission costs. But in addition to that, I'm pretty sure the 2-point spreads are going to outperform the 1-point spread. Okay? Because think about it, even if it falls slightly, if it fell to 127, I'm at the full loss here. I'm only about half the loss here. It's about the same monetary range. Okay? So why not the larger spread, James? Because I don't want to put up that money. I honestly, James says, why not do the 10, 15, 20? Because I don't want to put that much into one trade. All right? If I did a 20-point spread here instead of a 2, I sold the 128 and bought the 120. Okay? Yeah, I've got more strikes that I can play around with in this scenario. I'm sorry. Where's my brain? If it was available, the 108 spread, let's say. Now that's going to give me a very high net credit, but it's a very high risk. Okay? So let's say here I'm to 178. Let's say I did 10 contracts, okay? 10 contracts of both, okay? And I'm going to have another answer to you, James, in 1 second that you're not going to like, okay? And I don't mean to say that as a negative at all. I'm just going to say there is an easier answer to this question. I'm going through my reasoning. There's an easier answer to this question that you're not going to really like, okay? But let's do this. 128 to 126, I do 10 contracts. I put up $2,000. My net credit is only $220, but there I am at a 12.4% return. Because realistically, I'm not necessarily forcing myself to only 2-point spreads. I know in my portfolio what I'm going to allocate to each spread as part of my portfolio. Okay, regardless if it's a 2, and some positions might only have 2.5-point spreads that don't offer weeklies, or 5-point spreads. I'm okay with that. If I really like the stock and I'm interested in a spread on it and it only offers 5-point spreads, I'm okay. I'll do a 5-point spread. I'm not saying I won't. Okay, but what I know is that in reality, what I'm allocating in my portfolio is X amount into a spread. Okay, so in general, I take about 10 to 15% of my total trading account value and allow myself to trade that with spreads. So if all my spreads get wiped out at one point, I haven't lost more than 10% of my entire capital, because that can happen. Okay, so, but again, let's take your 20-point view. All right, $220, 10 contracts, risk of $1,780 or $2,000. Okay, it's 12.4% return. Let's clear out our put. All right, let's take that off the table. And I'm sorry, what week are we in? Are we in 7th or 21st? 21st, my apologies. I thought we were on the 14th again. We're in the 21st, 14 days out. 108 at 2 cents. All right. There's your answer. Okay. I take that 10 or 15% of my portfolio, which means I know right off the top of my head how much I'm really allocating to any spread, whether it's 1,000 is my limit So if it's a 2-point spread, I might do 4 contracts or 5, okay? Depending on, you know, what the credit is. I might be doing 4 or 5 spreads, or 4 or 5 contracts, James, I'm sorry, because I'm allocating X amount of money to the position. But look at this here. Sure, I get a much higher net credit of 68 cents as opposed to 22, but it's a 20-point spread. I'm only making 3.5%, and I can only do 1 contract to allocate the $2,000 that I have. I still have to pay something for this call. This put. It's going to be much lower. But I'm talking about making 68 cents against 2,000, where before I'm making, or $68 against 2,000, where before we were making 220 with a 2-point spread. The wider you go with spreads, using the same short strike with the same probability you want, the lower the return is going to be. Okay, so ask yourself that. Here's the answer to your question that you're not going to like, James. Find your balance. That's what you have to do. This is my balance for what I allocate in my account. And I like having that extra step to roll the short option down, maybe only 1 strike. By the way, here's another problem. Let's say I did this 20-point spread, and as before, the stock went to 128.65 as we talked about. I buy to close my 128, and I sell to open the 125. Okay, well, that's going to be a huge debit. I might not even be at a profit, but now it keeps falling, and I have the chance to roll down again, so I do. At this point, I'm taking more losses. With my 2-point spread, it's a control factor too, because I'll allow myself to roll down once, but if it breaches that again, I'm getting out of the position. Might be for a small loss, might be for a small gain, but I'm not going to allow this, percentage-wise, to happen. Okay? You can run comparisons. So later on, James, take a look this weekend if you have the time. Take a look at just any option chain and build a monetary spread. One stock, whatever stock you're researching. Find your short put that you'd sell out of the money. And then look at the numbers for risk, percent return versus margin, you know, return versus margin. If you did a 2-point, 5-point, 10-point, 15, 20, and so forth. And you saw here, when I get to this point, I'm not, here's the way to answer this. I've taken the risk up by about 10%, a factor of 10. I've also lowered the return by about a factor of 10 because this isn't dropping by a factor of 10. You know, the net credit increased by a factor of 3. Everything else increased by a factor of 10, including the risk, and the return lowered by a factor of 10. So that's the trade-off there, and that's why I don't think you'll like it. But no, there are times on, you're right, James, there are times on SPX when I'll do 10-point spreads to get a better net credit. Won't argue that at all. Higher priced indexes, ETFs, and so forth. Absolutely. I don't really do 20, again, because of my account size when I've already set aside to allocate. So what I think you need first, James, is rather than, and I don't mean to single you out, I'm really not doing that at all. And he says, there's always a follow-up. Will you prefer to sell more contracts of small spreads than fewer contracts of large spreads? No, it's more along the lines that I'm allocating about $4,000 total, $4,500 total of my portfolio to spreads. So that if I did these 20-point spreads, I could only do 2 spreads. Whereas if I do 2-point spreads and 5 contracts of each, I can do 3 or 4 spreads. One on an ETF or an index. Oh, okay, one would be on an ETF possibly. One would be on a broad-based index, which would have to be a 10-point spread. Then maybe a nice weekly stock that looks good, that's 2 weeks out, that matches the results of the searches I've been playing with the past couple weeks. Okay, so that's the answer. But you've got to determine. Here's what I just showed you is my other subtle answer to your question. I know it didn't seem like it at all. For any of you, and we've been talking a lot about spread comparison, management, early assignment, strike differences. It's good discussion. These are all great questions. These are all the right questions to ask. You guys are always phenomenal when we come to these webinars. These questions are the exact ones you should be asking. But I want to mention one more thing that I think is important. I told you that I was using about 10 to 15% of my account only. Because what is the risk here? I don't know what's happening with Celgene. You're right. Okay, but if I did the 128, 126 spread we showed, if Celgene just has something disastrous, not even disastrous, just some bad news come out, and it opens at 125 on Monday, I'm at a full loss essentially with 14 days to go. Okay? But that's why if I had 3 or 4 spreads open, each of these spreads would only represent about 2.5%, 3% of my total portfolio value, because I'm only taking 10% of my total portfolio, which you guys probably figured out. So I'm about 4,200, 4,500. So my total account value I'm applying to options is around 42,000 right now. Okay, but you look at this. Why would I do this? Because if I said that, okay, the market looked bullish, and I did a bull put credit spread on SPX that was a 10-point spread, and I found a higher price stock like Amazon, and I did a 5-point spread, and then I used this Apple 2-point spread. Whatever contract size it is, let's say I've got 3,800 allocated to it. And it's a 2-week trade, because that's what I found works best testing. Regardless if these were 20-point, 10-point, and 4-point spreads, or however you broke it down. If my sentiment was that the market was bullish, so I did all bull put spreads on these because it looked like everything was pointing in that direction, that sentiment, and over this weekend, what we've seen before in the past, with things that we don't want to mention that we know can happen, but a black swan event happens, and boom, we go into Monday morning and all the indexes are down 5%. All right, number one, we probably have bigger things in the world to worry about than what just happened to our account, but the one thing I can control in the account is that when I know I'm trading a strategy, even if I'm trading multiple positions in the same strategy that have the potential to lose 100% of what I invest, I'm making sure that each position probably doesn't represent a monetary loss of more than 3 or 4% of my total portfolio value. And in the spread section, because that's a possibility, I don't let it risk more than 10% of my total portfolio. So if you have a $100,000 account, you're going to hate me saying this, I wouldn't allocate more than $10,000 to trading spreads. I wouldn't do it, because you can run the risk. Even if you traded bull puts on 3 stocks and bear calls on 4 stocks, you could still lose on all 7 of them if you guessed the wrong direction, because some of them might have gone down, some might have go up. And if you're trading with $40,000, you might lose very quickly 40% of your total portfolio value. Okay? You don't want that. You can't have that. Okay? So yeah, I break my portfolio down. I've got conservative positions with about 40 to 50%. As I mentioned, I've got about 10%, this is about 40% conservative positions. 10% of that I allocate to options trading is in spreads. I'm having some fun right now with about 15% or so of my, it's a little bit less than that, it's about 10% also. 10% of my portfolio value into straddles with earnings, short-term, weekly straddles on earnings events coming up. And I've got about 20% trying calendar spreads once again. And then, you know, there's some collars. There's 1 or 2 collars I have open in there too as well, which should fall into the conservative, but I can approach that a different way also. So I do different strategies, and I break out my portfolio apart in that, because we had this discussion last week, but someone asked if I could trade only one strategy for the rest of my life, what would it be? It would be the married puts, because it has the risk control, which is the only thing I can control. I know that in the last 12 to 15 months, other strategies would have outperformed what I did in the married put positions by a factor of 10 to 15. Not 15% more. I'm talking about a factor of 10 to 15. I know that. But those are the same strategies that 6 months from now could take back all of the gains you've had in the last year. It might only be 4 months, depending on what the market does. That's why I diversify. There's not one strategy focus in my portfolio. There's different ones. There's a blog article we wrote about called sort of the barbell approach to investing. Okay. All right. All right. Sam was just bringing in a comment here. He says, look at AAO. He bought stock at 60 and sold 2 calls at 71 for next week and got $1. Okay, so they must have earnings coming up. So it was worthless. Oh yeah, so he sold the puts and then they were worthless today as well. Okay, yeah. All right, and you've got the puts, of course, going on Tesla as well. Yeah, so Sam's looking at AAO, which looked enriched premium here. Let's just take a look real quick. And of course, we are at 5:45, a little bit past 5:45 Eastern time. That's not a problem. If you do have any further questions, any last-minute questions, just go ahead and send them there as well. So let's say if I bought AAO today, 100. That's AAOL. Jeez, you can tell it's Friday, ladies and gentlemen. AAOL. Is that right? Look at AAOL. It's not showing me anything. Okay, there's Apple. I don't know why I'm not seeing that. Oh, because I'm an idiot. It's not an L. Like I said, Friday. All right, sorry about that. Next week out, July 14th. 60, jeez. Sorry, yeah. Okay, so his position was he got in, he said 300, but just put it in here at 62. This thing's, I don't know, wouldn't have done this. Well, I know you do, you got to put in it too, but yeah, you did it as a covered call. Got a little bit over $1 here for the 71 strike. So 16.5 potential return if assigned, but you received $1 credit, so you're protected down to 61. Oh, you had it at 60. That's why. Okay, you had it at 62. Let me guess, earnings are coming up next week? No, 8.3. Wow. It's a lot of volatility. 0.74 50-day volatility. Implied volatilities are in the 85% range. It's a lot of premium. Something's going on with that stock. It should be interesting to see. Oh, bank earnings coming up. Yep. Okay, let's see here. Let's go back. Oh, sorry, Rajiv's question. Let's see there. All right, so he says, bank earnings are coming up next week. Best strategy to buy, call, or use calendar JP Morgan. Okay, there we go. All right, so I need a drink there, Rajiv. I apologize. I need to quench my thirst, get a drink of water there. Okay, so yeah, bank earnings are coming up. You've got JP Morgan, Citi. What was my other friendly one I saw? I can't remember off the top of my head. So your question to me is, get that out of the way. On call. And I have a calendar? No, I don't. I can. I'm sorry. Oh, my apologies, Rajiv. There we go. Okay. So earnings are coming up. What does that mean? Stock could swing wildly one direction or the other. We don't know any movements that could happen in the position. So Rajiv is asking me, best strategy is to buy a call? Well, I don't know. If it goes up, yep. Okay. Why is that better than a calendar? Well, the calendar, okay, if you're doing a call, you probably want it shorter term to get the most bang for your buck. Let it go intrinsic if you're really bullish. Okay. What do I mean by that? Instead of going 1 month out or 2 months out or 3 months out, you might just want to buy 14 days out. You're going to pay into inflated implied volatility. You're going to suffer implied volatility crush, but at the same time, your delta is going to go to 1 very quickly, so you get more advantage of that. I know, Sam. I'm showing Sam. I'm with you, and you know what I'm going to teach because I teach it. Taught it the last, I'd say 5 of the last 3 weeks. So, but in any case, all right. So talking about J.P. Morgan, Citi. It wasn't Bank of America. There was another big one, and I'm going to trade it next week probably. All 3 of them, I think. Explain why in a moment. All right. So a long call here, Rajiv. If you're right and it goes up, you'll have a profit. If it goes down, you lose 100% of whatever you invest in that call. Okay? All right. And you're still going to suffer volatility crush. Calendar spread's better. Is it better? Well, I'd buy maybe a 2-month or 3-month out call that's got that extra time value, but then you sell something that's out of the money near term. So you get a high leveraged return, but if it really gaps up, you miss further upside, don't you? And if it goes down, you might not lose 100%, but you might lose 80% of what you invested in that call because it's gonna if the stock falls 10%, you buy an in the money 3 strikes or 4 strikes in the money call 3 months at a time, the stock falls 10%, this is going to go down 65 to 70% of its value. Yeah, that's going to expire worthless, but you're still going to be at a 60 to 70% loss what you invested in the position. Okay, so I'm going to pause the screen real quick here, folks. I'm going to do something very quickly. I'm going to show you this some of this discussion we've had in the past few weeks regarding these short-term long straddles. Sorry, I had to pause the screen here. I'm just going into my actual Power Options accounts. Boom, ba-doom, 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 ba-doom. Okay, so what I tend to do and what Sam was pointing out and what we talk about a lot is I tend to jump into a long straddle. Okay? Yeah, Sam, thank you for that point. Instead of a long, I'll get to that in a moment, but instead of just buying a call with an earnings anticipation, I would buy the stock and buy the put with a married put, because I know if the stock falls, I'm only losing 3, 4, 5% of what I invested. I can't lose 100% because the married put structure. It's more capital intensive, but when you take a gamble to get high return in one direction only, then guess what? You could lose 100%. Okay? So I would do a straddle. Buy a stock and buy a put, short-term expiration at the same time. Now, if the stock goes up 7, 8%, you're probably going to have a 20 to 40% return even though you bought both. You bought the stock, you bought the call and the put, so you've got two prices. The put expires, but you're still likely to have a 20 to 40% return. If it goes up 10%, you might be looking at a 50 to 70% return on the position. Okay, the stock falls 8%, 20 to 40. Stock falls 10%, 50 to 65 or so. The stock moves up 3% or down 3%, you might be looking at a loss of 50% of what you invested. And if the stock just moves 1% because earnings are meh, doesn't impress anyone, you'll be at a 90% loss. Okay? But if you're expecting a big move one direction or the other, it's not that you just want to buy a call no matter how bullish you are, because if you're wrong and earnings disappoint, you lose 100%. On the calendar spread, you'd lose close to 70 to 80%. If stock goes opposite direction, you're in a straddle, you might not make 100%, but you still might make 70 to 80%. Okay? So what did I mean by the three? Why did I keep saying the three banks? And it's because when I run my long straddle search here, Wells Fargo, that's what it was. Citi, JP Morgan, Wells Fargo, earnings are 7 days away. Looking at Friday expiration, net debit's around 185 for the straddle positions. Let's take a look at Citigroup real quick here. No, I'm sorry, let's take yours, Rajiv. JP Morgan. Stock is trading at 93.85. Let's say it stays in that range, and let's say it moves up 10%, 9 points next week. So we'd be at 102.85. Let's just call it 103, about a 10% movement on the 14th. Investment of 251. Put goes to 0. 93 call would go to $1,749 value on a $251 investment. It drops 10%. A bit of 9 points, I'm sorry, math, 83, let's call it a little bit more than that. Let's say it drops down to 83, about the same. Call goes to 0, put goes to 1,000. If you just bought the call, earnings disappointed, and it falls 10%, you lose 100% of what you invested. In the straddle, you'd have a profit. But again, okay, let's take this here, and let's say the stock moves up 3%. Well, let's say 2%, 2.5%. Okay, so it moves up, let's say 250. So it's about 94 now. Let's say it goes up to 96.25, okay? And I'm in this straddle. All right, so let's see, I paid 251 into the position. The stock's at 96. Yeah, I'd have a profit because this would be at worth intrinsic at 325. Okay, so if it moves up 3 points, I'm in a profit. Now, if you just owned the call, you'd have a gain of 169 to 325. But let's say everything looks good, earnings look good, and the stock drops to 90. Your long, oh, sorry, folks. Your long call would have gone to 0. Straddle would still have a profit. Okay, now we're going to suffer volatility crush, but again, look at these numbers. They're not going in volatility. These are going right to intrinsic value. So if I paid 251 for the call and the put, JP Morgan, the stock around $94 per share. If it drops down to 90, a $4 drop, sure. My 93 put's going to be worth $3 of intrinsic value. I'm going to have a 50-cent profit on a 250 investment. Not bad, but you would have had 100% loss on the long call. And you would have had a similar percentage loss, probably 80 or so, on the calendar spread. Okay? So remember, you're expecting a swing one way or the other. If you're disappointed and you just take one direction, you'll lose 100%. But if you do a straddle or strangle perhaps, which needs a wider move to get to the break-evens, you can profit in both directions. Okay? So you're what? if the stock moves up 5%, you won't make as much on the straddle as you would have on the long call. I know. But you don't know what's going to happen at earnings. Earnings are I'm expecting X, but could get really disappointed with Y. But you know what? In this structure, if the market was really disappointed and the unexpected Y happened, I might be at an 80, 90% return on this investment. It's potential. It's got the potential. Look for straddles and straddles to play earnings. Yes, you suffer volatility crush. It's going to happen. But at the same time, instead of taking a directional bullish or directional bearish, where you could lose 100% of your investment, in most cases, to lose 100% of this, the stock would have to be trading right at 93. It'd have to have no movement, essentially, from the earnings and no movement next week. Okay? And Sam's a little safer. So what Sam likes to do is wait till after the earnings and then decide if it's a bullish or bearish sentiment, and then play the long call or the calendar spread or the married put or the long put after the earnings. But I'm trying to develop a technique here of going into these short-term earnings here, see what kind of profits long-term can pan out. Just another test we do, and I have the time and not answering the phone and everything along those lines as well. All right. Well, ladies and gentlemen, I'm sorry it is 6 o'clock Eastern time. We stayed a little bit online longer here, just as we promised that we would. So I just want to remind everyone, of course, if you haven't done so yet, remember, you can take a 14-day test drive to Power Options at any time. Just go to support@powerop.com, put in your first name, last name, and email address. You'll have full access to the site for 14 days. After that, we do have various subscription levels. My apologies. We do offer an end-of-day service. The data is only updated at the end of the day, and that's $40 per month. Our delayed service is $60 per month, 20-minute delayed service. And we do, of course, offer a real-time service. And then the back testing, which we didn't look at today, you can do historical searches in the strategies, view historical options chains. That data goes back to April of 2006. So more than 10 years of historical data for backtesting purposes. I mentioned what I'm doing with some of those other strategies as well. Those are available as upgrades to the 20-minute delayed and the real time. All right, and if you want some other free information, remember you can check out our blog anytime, blog.powerop.com. And as mentioned, as always, that webinars page where we archive our presentations, you can view that at any time. Just go to powerop.com/webinars.asp. Tonight's presentation was, of course, recorded. It'll have to spend some time converting, and then I'll upload it there later. So you'll receive an email on Monday, of course, when this webinar has been posted. Remember, you can always check out our YouTube channel as well. And, of course, if you have any questions later on, you think of anything else you want to ask, send me an email to support@powerop.com. You can also reach us at support@radioactivetrading.com or call us during market hours at 302-992-7971 as well. And those of you that are current members, remember, you can sign up for a coaching session at any time. Well, ladies and gentlemen, thank you for joining me tonight. Thank you for your great questions and the spirited discussion. I hope everyone has a fantastic weekend. Sam says, thank you, very kind. Have a relaxing weekend. Spend time with the family. You too, Sam. Take care, and good evening to all. Take care, ladies and gentlemen, and we'll see you soon. Good night.